Joining me now for a closer look at what's playing itself out in that market scene is Richard Quarter from Argon Asset Management. Richard, always a pleasure and a good afternoon to you.
And good afternoon to you too.
All right, Richard, I think quite a bit to maybe look at this today. The European market's down in the red. I think it's the second day in a row. Yesterday we were contending with the fact that France went and called a snap election. Today maybe all eyes are on that US Fed. But even here at home, not the prettiest picture except for financials seeming to be enjoying some gains.
Yeah, so at the moment, it's very interesting times, not just in South Africa but around the world. I mean, there's a whole bunch of elections taking place. We've had EU elections taking place late last week, and I think maybe the markets are still just coming to terms with what. I'm not sure it results in anything sort of materially different in terms of policies as yet, but maybe it's sort of indicative of how the sentiment in Europe is changing. It seems to be like the more centrist to right-leaning parties are starting to gain traction, and as the market doesn't really like uncertainty, it likes to have a sort of a clear path forward. And when you sort of see these sea changes, the market sort of reacts a bit more in a volatile fashion. In terms of like our banks, I think it's a similar story. I think market participants are sort of just waiting to see how our elections bed down and the way forward, and yeah, I guess we all are actually.
I'm also keen to get your thoughts here on how markets happen to be holding up, considering that South Africa's political environment is a little bit uncertain right now. I'm actually quite impressed by the steadiness of the nerves on the markets at this point.
Yes, I mean, this morning or like the last couple of days, we've actually seen SA government bonds, the yields come down, i.e. the price rising. So the bond market seems to be quite optimistic about how these coalition discussions are going, which is a good sign of anything can be read into that. I think we've seen like the longer dated SA government bonds come in by about 50 bips, which is not insignificant. So yeah, I mean, at the moment, I mean, the rands around the actual time of the elections was a bit volatile, but now it's sort of holding steady at like that 1870 sort of level. Bond yields are falling, so i.e. bond prices are rising. So it seems that the market when it comes to South Africa is turning. It seems like there's some optimism creeping in.
Well, optimism is good for us. Where we aren't seeing much optimism here, Richard, is with our miners. I think if you just look at the bottom 10 of the top 100 today, I think 8 out of 10 of them are all miners here in South Africa. Keen to get your thoughts on what could be driving that one. We know that every few days, really, our resources counters just get a beating.
Yeah, so, look, I mean, we like to look at sectors like in this quite broad category, but like within our resources space, you have some miners that are very much like SA orientated, like some of the platinum miners, but like basically all of their resources are in South Africa, all of their cost base are in rands, pretty much. And versus you've got other listed miners that are global businesses with like very little exposure to South Africa. So often it's like a macro story that is driving that. Some of the narratives around resources. I mean, the gold has pulled back slightly in the last little while. The rand has strengthened from about a month prior to the election. If you remember, it was like over 19 rand to the dollar. So we're now below. We almost touched at like 1850 leading into the elections. So. Yeah, I think one needs to just drill down a bit more into each particular counter just to see what's sort of driving the share price performance.
And then, of course, all eyes are on the US Fed tomorrow. I'm also just keen there to get your thoughts on that trajectory. I have read articles that said they're still expecting 2 cuts. I've read articles 1 cut. I actually am at a point, Richard, where I wouldn't know what to believe and I wouldn't know how to base a decision on it because everybody who speaks about it has so much conviction.
Absolutely. I mean, it's a tough one. I mean, I think in the beginning of the year, I think some people were saying as much as 6 cuts during 2024. And now we're halfway through the year, and now we're debating whether it's 2 cuts or 1 cuts. But I like the word you use, trajectory. The expectation is still around cuts in interest rates. But if you look at what the Fed has been communicating to the market, they always talk about we targeting a 2% um, uh, stable inflation rate, and we consider unemployment. So the US economy is still appears to be quite strong. Unemployment is very low. Like the stock market is going gangbusters. Admittedly, it's very concentrated, and inflation is still hanging around above 3%. So, like, I'm just a bit cautious, or we're a bit cautious around the expectation around rate cuts in the short term. It doesn't seem like there's a need to cut rates, and I think the Fed will be highly incentivized to cut rates when something breaks, and nothing's breaking at the moment, it seems.
Everything's holding too strong, actually, Richard. Let's touch on the
Yeah.
company news today, a very quiet one, but Premier Foods out there, a maiden dividend. It looks like this listing was a good idea, and it also looks like the company's strategy seems to hold. Sometimes when a darling is listed, Richard, you don't know if that darling is going to remain a darling, but it looks like Premier's okay.
Yes, it was a good set of results. I mean, the top line growth was a bit muted at like 3 to 4%, but I think EBITDA grew by a high double digit. I think it was like 18 or 19%. So that's achieved by a very good cost management and like focusing on efficiency. So very good performance by the management of Premier. And like that all filters down to the bottom line, where I think headline earnings per share was up, I think, well over 20%. So, and then as you mentioned, a maiden dividend. So a good set of results for Premier. On top of being able to pay a dividend, also their gearing has improved. I mean, they're now below 1 times gearing. So a very strong looking performance, and a very strong position that they find themselves in. Also, the valuation seems quite interesting because it's trading at a bit of a discount to some of its listed peers like Tiger Brands and AVI and even RCL Foods. But the only thing that sort of counts in their favor is that it's relatively small in terms of market cap, and also the free float is even smaller. It's I think the top 3 shareholders own about 70% of the shares outstanding. So it's, I think, an 8 billion rand market cap. So the free float is a lot smaller than some of its listed peers. So probably contributing to why it's trading on a discount to other food producers on the JSE.
Well, that's it, Richard. I'm keen to get your stock pick, but first I'd like us to reflect on counters that have found favor with your industry peers.
The flip side to this, we've been talking about value in SA. The banks obviously came off after the ANC lost its majority, and then so if you look at somebody like Absa at about $150, what Grant was saying, guys like us like businesses that generally produce. The accountants, IFRS makes noise of financial statements, but generally this business is probably on track to give 25, 26, 27 rands worth of earnings this year. The outlook next year, early-ish, should be for lower interest rates, which would take the burden off some of those non-performing loans. You're getting almost a 10% dividend yield. If you take, I think, 14 Rand 80, it is on $150. For getting dividend withholding tax, you're getting almost a 10% yield. So for me, it's almost like you've got a free call option on this thing.
I'm going with a stock by the name of Autodesk. Now, they're one of the original computer-assisted design developers. So they provide software to enable engineers to design whatever they're designing. And they also play heavily in road, rail, water infrastructure, etc. I think they're perfectly positioned to capture some of the narrow AI evolution. So in other words, they've got a huge data set, 30 plus years of detailed information of building projects and data that they can train their own models on and push out into like a connected cloud live feed into their client base.
Pepco I think the guys have a nice exposure when it comes to the lower LSM. They've got a nice exposure to people who are looking for value for money. The likes of Pepco, what they're offering is no longer classified, as just for the people with lower income. Even people with high income, they do go now and then there to pick up something. And we know that their headlines were down all because of the cost they had to incur when they were acquiring your clients. Fintech revenue contributing almost 7% of the group revenue and continues to grow.
All right, Richard, keen to get your thoughts on some of those counters. We have Autodesk, Pepco, and ABSA.
Sure. So starting with ABSA, so that's we sort of agree with the sentiment that your other guest put forward there. So we also think it looks very cheap. I mean, it seems to be on the highest dividend yield amongst the big four SA banks. And it's our largest exposure to SA banks. We just think that it's ABSA in particular, well, all of the banks actually are going to benefit from a slightly higher interest rate environment, from having been able to expand the net interest margin. And also at the moment, the credit losses don't seem to be coming through as I think some might have feared or expected. So we think it's a nice way to play the whole SA Inc. recovery sort of narrative. We think it's priced cheaply enough to sort of limit our downside. So yeah, so that's one that we agree with, and we also have a position in ABSA. On Autodesk, it's not a company that we know in a lot of detail. It's not that we are negative on AI. I mean, we do think like AI and is going to have a positive impact on society in terms of production and well, actually, and in ways I'm sure we can't even consider at the moment. But two things can be true at the same time, where AI can have a very positive experience in society, but you can still have expensive stocks that are exposed to the AI phenomenon. So that's the one thing with all of these companies that are touting their AI capabilities, is we just be wary that if the valuation is too high, then a lot needs to go right to justify those valuations. And your investment return comes from the price you pay for these businesses. So we're just a little bit cautious on anything sort of AI related. And then on the last one, Pepco, I don't have too much to disagree with what your guest said. We also like those retailers that play in the sort of value space. Just our preferences for Mr. Price of the Pepco is just they are similarly rated, but Mr. Price has been around for a lot longer in the listed sphere. So that's yeah, but that's not turning down on Pepco.
With that said, Richard, which counter are you loving this afternoon?
One we've spoken about before in your show. Just we're going to stick with Netcare. I just think it's sticking just very cheap at the moment. The market doesn't seem to be pricing in any sort of potential growth going forward for the business. I think it's like an 8 or 9 times forward PE multiple. But as we've seen in the last set of results, these are businesses with a high fixed cost base. So the market is very concerned about where the volume growth is going to come from in these businesses, but they are still able to get price increases through. So as you've seen with Netcare, is that in spite of very muted volume growth, they were still able to grow their revenues, and the operational leverage came through and their margins were able to expand. This is on top of them incurring additional costs at the moment. Well, additional costs last year in terms of load shedding. That's a bit more, it's fallen off a bit now with the lower levels of load shedding. And also they've had some strategic projects that they've been investing in over the last couple of years, and those are starting to roll off and fall into the base. So they are very much cash generative. I think they're sitting on like a 5% dividend yield. That's not taking into account the share buybacks that they're currently deploying capital into. So they are just focusing very much on their core strategy of running private hospitals in South Africa. They're not deploying capital into other sort of areas in the hope of growing top line revenue. So it's one that's it seems that the range of outcomes seems very much skewed to the upside. The downside seems to be quite limited, and a very strong balance sheet, which is also part of the investment case. So that's why we go with Netcare.
Wonderful, Richard. A pleasure having you this Tuesday afternoon. Thank you so much for your time and insights. That was your midday markets update with Argon Asset Management's Richard Court.